Have you ever bought a product or service and it looked like the best option at the time, but then after you've already bought it, you find out that a better option existed? You're like, man, if I only knew about that other option, I would have bought that. Why didn't so-and-so show me? Or how come I never knew about it? This happens with everything. When it comes to high cash value life insurance policies and taking out loans, the same thing happens in respect to being aware of different options. Now, all different whole life insurance companies and products have different loan rates. We covered that in the last video, and we've got a lot of content that really goes into how policy loans work and a lot of information. What we're going to look at here is one policy and a number of options that exist with one policy with one company, just to provide transparency. Because often what happens, we see this a lot with real estate investors or people who are very concerned about their money. They want to make sure that they are earning the maximum returns, their money is growing as anticipated, they see their value there, and that also they're paying the lowest possible interest rate. Meaning if I'm a real estate investor, and I am purchasing a piece of property and I can finance through a bank at 2 or 3%, or I can finance through my life insurance policy at 5%, why would I do that? Because the cost to borrow is higher from my policy. So I want to see the numbers up front. So what we're going to look at here in this video is one policy on a 40-year-old male funded at $50,000 per year for 7 years, maximum cash value. We're going to look at taking a loan with a non-direct recognition contract. And what you will see here is the cash values and loan balances will be different. These are just the same numbers that we looked at in the last video. But the loan interest rate on the non-direct recognition contract is 4.5%. However, to provide some additional transparency, some companies will bill loan interest up front. And if you pay everything up front at the beginning of your anniversary date, what the company will do is actually give you a discount. And you're going to see that in this video just to really crunch the numbers, which if I'm an investor and I'm taking out a $500,000 loan, the difference between 4.5 and 4.3%, that'll add up over time. So we want to show the clean net numbers. That's what we're going to look at here, paying the interest before the anniversary date and get the discount rate, which a lot of people do if they are aware of that option. Awareness, seeing the different options here. Then we're going to look at a direct recognition contract. Same policy. You're going to see everything is identical in this example. It's one of the major mutual companies that offer both direct and non-direct recognition. Same thing, but here's the difference. You'll see a fixed 6% loan interest rate. However, again, if you pay it up front, what happens is they offer a 5.66% loan interest rate if the interest is paid on or before the anniversary date. But what do you notice here? If you're an investor, here you've got a 5.66% cost to borrow, whereas with the non-direct recognition option, you have a 4.3%, cost to borrow. What am I earning on the policy when I compare it to what am I paying? You're going to see that. We're going to lay it out side by side. And then we're going to compare it to a cash value collateral loan. Great option that a lot of people are not aware of, especially right now in this low dividend interest rate environment. The company we're going to look at has a dividend rate of 5.65% for 2021. Now, for further transparency, that gives you a net internal rate of return, meaning the actual rate the policy is growing by, of just over 4%. It's a little bit north of 4.1% on the annualized IRR. We're going to go through the average IRR as well. That's going to fall between right around 3.5%. You'll see it. We've got the numbers up there to make it transparent. But what I want to touch on here is if I'm the consumer doing this, which I am, this is actually a company that I've got many policies with. If I'm earning 4% based on the current dividend rate, or a little bit greater year over year, and I can borrow directly from that policy at, call it 5.6%, or maybe it's 4.3%, while I'm earning 4.1, does that make sense? Because I've got a negative spread on paper and in reality. Now it is a direct recognition company, which they do raise the dividend rate on borrowed funds like we covered in our last video, but the net IRR is still lower than the cost to borrow. That's where this option is beautiful to be aware of. Not everyone likes it because I give up a little bit of control. Some people love it because of the interest savings. So let's get on into the numbers and have some fun. What we will start with is a non-direct recognition policy here. We're going to walk through this. On the left, we see the policy on a 40-year-old male funded at $50K for 7 years. We juiced this bad boy. When I say juiced it, funded right up to the 7-pay premium for 7 years, reduced paid up afterwards. Yes, we could keep funding, but I wanted to max out that cash value over the 7-year funding period because a lot of people are interested in these type of designs if I'm funding for 5 to 10 years. So here I see the break-even point highlighted in yellow. Break-even means I've got more money in cash value than what I've paid in. Year 4, I've paid in a total of $200,000, 50 times 4. I've got 202 in cash value. Annual internal rate of return, that's the net growth rate I see year over year. So again, this company had a dividend rate of 5.65%. That's not what I'm actually earning on the policy. What I am earning after the company's insurance expenses is this guy, IRR, internal rate of return, which tops out annually at about 4.14%. The average, if I want to scroll down a little bit here, we see get strong a little bit above 3.7%, almost 3.75% when I'm in my 70s. Not bad for a safe, liquid, tax-free area to position money, especially right now in the low interest rate environment, but that's the average internal rate of return. Very important to show this. If you're an agent, never ever tell someone, here's the dividend you're earning this year, not wanting to show the IRR because it's a lower number and we're afraid that we might not get the sale. Someone might say, that's not high enough, I'm not gonna buy this because my expectations were set differently. Imagine if they do move forward thinking they're earning 5.65%, only to find this out after the fact. Now you've got a different problem on your hands that was not worth any type of commission. It's not worth it. That goes on a lot in the industry. So what I wanna touch on here or really dig into is the internal rates of return so we can see what we are earning compared to what we are paying in interest costs. So this is a non-direct recognition policy where the loan interest rate was what? 4.5%, but if I pay it annually at the beginning of the anniversary date or pay it off anytime prior to the next anniversary date really, it's 4.31%. That's what it nets out to. So what we've got here is a 4.31% interest rate. We take one loan here at age 50. We can borrow anytime we want. But when I take that $300,000 loan, the gauge that determines how much you can borrow against the policy is whatever you have in cash value. So what we can do is compare the policy to the example when I just let it sit and grow compared to when I borrow against it. You notice a cash value reduction. Also, you'll notice it drops a little bit less than $300,000. We're accounting for the loan interest in this case as well. What else do you notice? Look at the death benefit. That reduces, factor in the interest as well, dollar for dollar in that case. And that'll happen anytime with any company, whether it's non-direct or direct recognition. So here we see the $300,000 loan come out. We see the loan interest cost, and then we see that we are paying it out of pocket. So in this model, we're assuming that we are paying the interest annually. First year, we pay nothing toward the principal balance. The next year, we apply $50,000 toward the balance. So we're covering the interest out of pocket each year, and then $50,000 toward the principal. Tally up those principal payments. It'll give you $300K, which matches the amount we pulled out in a loan. And then if we tally up those interest payments, we've got it right here. You've paid a total of $45,000 in loan interest. Now, if we look at this in orange, that's your cash value restoration after the loan is paid back, $618,000. What does that look like compared to the example when you just let it sit and grow? $618,000. Same thing with the death benefit. So with a non-direct recognition company, the company does not recognize the fact that we take out a loan, and I receive the same dividends and interest, the same internal rate of return on any money in cash value and what's outstanding in loans. So if I pay it back fully restored to what I otherwise would have been. Let's progress on to the direct recognition model. Fun stuff, right? So here, identical policy. You can see that on the left. Cash value, break even, all that good stuff. Difference is just the loan interest rate on the surface. This is a direct recognition contract, 6% cost to borrow, but what was the net? 5.66%. Now what I want to add here is this company, on whatever the loan balance is, direct recognition, they still pay a dividend, but they actually raise it to 6%, where their standard dividend rate is 5.65%. So the larger mutual companies do have a practice, they've done this for several years now, of raising the dividend rate on borrowed funds. So what you'll notice here is when I take the loan out of $300K, it's the same impact. Very similar to the non-direct recognition example. Same company, same illustration, all that good stuff. Age 50, there it is if I let it sit and grow. IRRs are identical. But when it's paid back, a couple things I want to touch on here. There's the loan interest. Do you remember what it was in the non-direct recognition example with the 4.31%? It was $12,000 and change. Here it's almost $17,000 in the first year. Paid back, the same principal payments, $300K, but look at your total interest costs over time, about $60,000. So let's go back. Non-direct, your interest cost was what? $45,000. Direct, almost $60,000. So we've paid more in interest because the cost to borrow is higher. With that said, look at the difference here. Cash value restored to exactly what it would have been, and a little bit more. Would have been $618 if I just let it sit and grow. Borrow and repay, it's $622. Now you've got a $4,000 difference, but you've paid about 15 grand more in interest compared to the non-direct recognition example. So the non-direct's better in this particular case. Now things change over time, and really I don't think it makes a huge difference when you look at reality, not just projections, but still it's good to be aware of those numbers. If I'm an investor, I'm looking at that kind of stuff and directly comparing the cost to borrow from my policy compared to an outside source, or just purchasing something in cash. That's what goes through our heads. Let's look at the last example here. So we looked at direct and non-direct recognition. Let's look at a collateral loan. With this, it does not matter if your policy is non-direct or direct recognition, because you're not actually pulling the money from the cash value. You're taking your policy to a bank, to a lender, and saying, I've got this much cash value. At age 50, I've got 450 grand. I'd like a line of credit. I'm going to assign my cash value as collateral for 450 grand. Maybe it's 400 grand. We've got videos on collateral loans. Typically, you'll get a 95% LTV. Some banks do 100%, depends. But here's specifically what I want to look at. What were my interest costs in the last two? Non-direct was what? About 45,000. And direct was what? About 60,000. I know I'm rounding. What's it here? I've got the same thing going on. Cash value growth over time. There's my break even. Don't need to go through that. Look at the IRR. This is so important to so many people and often brushed over. You must be transparent when you're working with people's money. With anything, really. Here we go. $300,000 loan. 3% cost to borrow. The policy is going to perform exactly the same. Look at this. $618,000. Same on every slide because it's the same policy. The difference, now I've got a $9,000 interest cost, much less. And then I apply the same $50,000 per year toward the principal. That's a total of what? $300K. And what do you notice here? When I have paid it off, total interest cost, $31,500. What's my IRR? If I look at the same point in time. Annually, 4%. Average, 3.6%. If this was a business loan on the bank's paperwork, often I can classify that, which makes it easier for a potential tax deduction there. Not giving tax advice. I'd always consult with a tax attorney or CPA, but you know what I mean. If I'm earning this tax-free, if I don't trigger a taxable event, and I can deduct that, yeah, that gives me a huge advantage. And I have the death benefit that's paid income tax-free to my company, to my family, my legacy at the end of the day. But this gives me an actual positive spread where so many investors look at the fact that, hey, here's what I'm earning on the policy. It's money sitting in cash. I like the safety, the liquidity, the tax-free benefit, but if it's a higher cost to borrow, it doesn't make sense. Now I've got this option. Hey, this is great. If things become more attractive down the road, if interest rates come up and my policy outperforms the cost to borrow directly from the policy, then I'll go back to that. And we can pivot as time passes. So I hope this one made sense. I hope you enjoyed it. I love going into the numbers, which if you've seen any of our videos, you know that. But if you did enjoy, please hit the like button, subscribe for more, and as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.